over to Ashley and Hélène from respectively Sofala Partners and BetterChain. Thank you for the work you did well and quickly over between January and early April to do these interviews, and look forward to hearing from you today. So what we and Ash, what we I think what we described over email earlier is that people are we encourage questions and encourage discussions. So if you would like to get in the queue to ask a question, one way to do that easily is just to put a note in the chat box, and we'll monitor that. So you can just say, you could simply say, sort of, I'd like to ask a question. If you would also like to type your question in the chat box, we'll do that as well. I may still call on you to ask the question as time allows. We'll just do whatever is possible time-wise, but we'd be happy to hear many voices on the call today, but we can use the chat box to sort of organize that. And there might be opportunities as well where I just sort of ask verbally and people are welcome to chime in. So we'll go through the presentation, and Ash and I then may have some pause points where they take time for questions. Otherwise, we'll certainly have that time at the end. So with that, Ash and Hélène, thanks for being on, and I will hand the parole, the speaking over to you.
Great, thanks, Jen. Hélène, do you want to go first and introduce yourself?
Yeah, so hi, so my name is Hélène de Balzac. I'm working for BetterChain. I was part of a Sofala partnership area of this research. So BetterChain is a company that promotes transparency on the mineral supply chain.
Okay, thanks, Hélène. And my name's Ashley Elliott. I'm a managing partner at Sofala Partners based in Kenya. So very much kind of good evening from Kenya, but I guess good morning to those of you on the West Coast and at points in between. I guess just quickly before we dive in, it's worth sharing just very quick background on Sofala, which might be a company less familiar to some of you, and then also just on the approach that we took for this report. So just in brief, Sofala is we're a specialist risk and investment kind of advisory firm focused exclusively on sub-Saharan African markets. We have offices in Nairobi and in London. And I think of relevance to this report is just to say that, you know, our professional network and sort of client base across the African continent is probably strongest within the investment community in the financial sector. So I think that's really the angle that we bring to the report. And I do want to kind of recognize and acknowledge that many of you kind of on the line today will have greater depth of expertise in you know, in particular aspects of responsible mineral trade issues. So that's Sofala. And then just in terms of our research approach, as Jen sort of alluded to, you know, this was a desktop report. We had a fairly narrow time window for our research, and I do want to apologize to those of you who we had wanted to talk to and to interview, and where we just ran out of road. But I think within those constraints, we were able to obtain some really good insights on a topic which maybe hasn't been covered so much before. And in total, we interviewed 47 different stakeholders, mostly by phone. I think it's worth just grouping those into some broad categories. So, you know, first of all, we spoke to CEOs and kind of compliance officers and lending officers at Congolese banks primarily, so kind of locally based banks in Kinshasa and elsewhere. Secondly, we spoke to global banks. Obviously, there's only a couple of those with a presence in Congo, it's really just Stanbic and Citibank, but also banks that have an interest and a presence in the wider Great Lakes region. I'd say a third category of interviewee was development finance institutions and multilaterals. And then a fourth was kind of mining companies with a footprint on the ground in DRC. Fifth would be what I sort of term the global trading houses active within the 3T and gold supply chains in the Great Lakes region. And then finally, kind of moving further up the supply chain or the value chain, you know, we spoke to a number of prominent kind of midstream and downstream players. So there I'm talking about the refiners, the smelters, in some cases kind of, you know, manufacturers and consumer-facing firms that you know, whose supply chain originates in the Great Lakes region. So So I hope that's just useful, very brief context. I think, without any further delay, let's dive right into the content of the report. And Hélène, over to you to kick us off.
Yeah, thanks Ashley for the introduction. So I will start with the part one, identification of issue and mapping of financial flow. So the first thing that I want to highlight is like in the 3TG sectors, upstream actors really need access to finance for their trade operation, to support the working capital, to invest in the efficiency of minerals extraction, and to support the cost associated with responsible sourcing of minerals. So the first slide, financial flow through the treaty supply chain. So this slide represents really a simplified metal supply chain, where you can see that the blue arrows represent the flow of treaty minerals and the green, the flow of money. We see that from the midstream to the upstream level of the supply chain, the trade of minerals is usually based on advance payments. At the upstream level, we see that neither miners or local traders or cooperatives get access to finance through financial institutions. The research has shown that treaty exporters who have a less high-risk profile than the other upstream actors and who have a better financial record could potentially get access to loan, but the loan conditions are really not appropriate for the business. So usually local banks propose really a high-risk interest rate around 12 to 20%, and the collateral are really not adapted to the ISM sectors. So usually they request collateral such as land or building. We also see that of all the upstream actors in the treaty supply chain, exporters in the Great Lake region that are part of a wider conglomerate have the best ability to overcome the access to finance challenge, as they're typically able to arrange a low-cost financing either in-house through cash flow, for example, from other operating division, or offshore. Also at the upstream level, we see that exporters provide advance money to affiliate négociants, so local traders, and the négociants are usually affiliated to several exporters and resell minerals to the higher bidder. So this really creates a risk of repayment delay for exporter and really a preference only to advance funds to the trust négociant. So insecure pre-financing of négociant creates really a cash flow problem for the exporter. On the next slide, you see a diagram that shows that the nature of the payment loop between the DRC-based exporter, the smelters, and the global traders create really a structural cash flow challenge for the traders. So basically, the traders advance the money to the trust exporter, but they're getting paid back by the smelter when the minerals arrive to their premises. So usually we have between 3 to 5 months between the time they're advancing the money to the exporter and the time they receive the money by the smelters. But we have seen that the international trading company are generally able to overcome this financing challenge in the treaty sectors. The research shows that the international traders have access to credit to finance their business, and they face usually few problems when banking in US dollars in DRC and making cross-border payments. Due to the strong history of Africa and Europe trade flows, European banks are generally happy to transact in DRC and to enable the payment, whereas US banks are much more likely to block payments due to the perceived jurisdictional risk in DRC. We have seen as well that for the treaty smelters have limited incentive to offer inventory finance to upstream players, as there is a few competition to secure the procurement. And this is especially the case in the tin sectors. In the next slide, so I'm talking here about the financial flow through the illegal ISM gold supply chain. So just want to highlight a couple of important data related to the gold production and trade. So ISM gold represent around 15% of the global gold output. The main buyers of gold are India and China. Together, they are buying around 50% of the global gold production. The main end user of gold are the jewelers, and in second position, we have the investment bank. So now come back to this slide and to this diagram. So this diagram shows a typical illegal ISM gold supply chain from DRC. you can see that the yellow arrows represent the gold supply, and the green one represents the money advance. We see that the illegal gold economy in DRC is really vast. The shadow economy is by far the largest component of the overall ISM gold economy. Smuggling in DRC is highly institutionalized. It involves different types of actors, such as local businessmen, government, and army representatives, who are intrinsically linked to each other. In this diagram, you can see that the vast majority of the ISM gold extract in DRC is smuggled to Uganda. And once in Uganda, the illegal gold is exported usually to Dubai to be sold in the souk of Dubai or to other locally based refinery. Like for the treaty, the ISM gold trade is also based on a pre-financing system. But for gold, the system runs really on an opaque cash-based financing. The researchers have seen that it's quite complicated to create a premium for fair trade gold because money launderers and cash-scarce businessmen bid up the price of illegal gold. In regard to access to finance, we have seen that upstream gold supply chain participants are both unable to access legal form of credit due to their high-risk status and also unwilling to access credit because the interest rate from local banks are often higher than the margin on gold sales, pushing them really to rely on the informal arrangements. Additionally, we see as well that the global banks perceive money laundering to be associated with the ISM gold trades. And in addition, the smuggling incentive and the perverse incentive created by high taxation represent as well a key challenge to formalization of the ISM sectors. On the next slide, we highlight the financial flow through the legal ISM gold supply chain. So this diagram shows example of traceable and legal ISM gold production in DRC. It's based on two projects, the Impact Just Gold project, which is still ongoing, and the USAID CBMT project, which was implemented by Tetra Tech between 2014 and 2018. So those projects aim really to trace conflict-free and legal artisanal gold from mine site to end user, while applying regional and international standards applicable to conflict-free and high-risk area. However, we have seen that gold volume have been really low, representing really a challenge to sustainability. Low supply volume is problematic in the context of the cost economic of the sectors, as gold shipment really need to be relatively high volume to achieve the cost recovery in the gold ISM gold sector. So really a main challenge is to be able to channel the gold into the formal supply chain. For instance, in the case of the CBMT project, a key barrier to greater supply volume was that the site level manager who advanced the payment to the miners were also site selling to the affiliate negociant. What we really see is like really illegal mining and mineral trade activity in the gold sector usually generate more value for local supply chain actors than compliant one. And also, we see that the DRC market is undercut by Ugandan and Rwandan company who can buy illegal gold from DRC and have lower cost. This is specifically the case, for example, of this refinery based in Uganda owned by the Belgian Alain Gotz. Barrier to financing in the formal ISM gold sectors. So we have seen that upstream gold supply chain participants are largely unable to access legal form of credit in the local banking sectors due to the perceived high-risk status. So for the bank, ISM gold is necessarily associated with bad practice. Banks drew an explicit link between ISM gold and the risk of money laundering. In addition, we see that miners are mobile and usually informal actors, creating a high-risk status by default. Also, the issue of small quantity exports mean for the bank a really low financial return and a lack of profitability. Also, the bank do not have the internal capacity to really measure the risk related to the upstream operators, and they consider that due diligence costs to eliminate this risk will be too high for ISM gold, where the financial return is really low. Regarding these two examples, we have seen that at the upstream level, in the Just Gold project, for instance, the pre-financing was given by Faircongo, so the local exporter, to the cooperative before the extraction. Normally, this lending is really viewed as really too high risk. For instance, it was not the case in the USAID CBMT project. But in these two examples, there's also some challenge related for the midstream and downstream business partner to provide inventory finance to support the gold trade in DRC directly to a Congolese entity. In this case, the Global Bank were really reluctant to accept gold-related financial flow from Africa due, as I mentioned before, the suspicion of money laundering and the really high costs related to due diligence, and also the reputational risk to be involved in the gold trade from a high-risk country. However, the research has really showed that it's not only the reason of the risk related to the DRC, which block US bank to transfer the money to DRC, but it's really the combination between the fact to be involved in ISM gold trade and the high-risk stages of DRC. So the solution that was found in those examples was that the local exporter have received the inventory finance from the refinery, but through his US entity. Thanks, Ashley.
Okay, great. Thanks, Hélène. You've been brilliantly concise, and I will try and be as disciplined so we can create a good amount of time, for Q&A and discussion. Otherwise, I don't want to speak at everybody for too long. But Jen, perhaps if we go to the next slide, I will just pause and kind of pick up a few of the key points in these remaining slides. Okay, great, thanks. So guys, I just want to comment on a couple of sort of top-line themes here, and Hélène has covered one or two already, but I think one of the big things that came back through all the interviews we had with regard to the gold sector is just how much the supply and demand dynamics, for that sector are sort of defined by the nature of gold. It's not just a commodity; it's also a store of value. Obviously, it's also used extensively as a currency in a sense, and a medium of exchange. And as Hélène pointed out, that means it's pretty hard to create a sort of bifurcated market where you have a premium price for legal, traceable gold over and above the main market. Great. So just if we just jump to the next slide. Okay, great. So just a few issues here specific to artisanal operators. So the first point is really just that unlocking access to finance for the kind of the legal conflict-free ASM sector, if you like, is about much more than just solving financing bottlenecks. So I think if I was going to leave you with just one point from the whole presentation today, it would be that we need to think about this in terms of solving the much broader barriers to formalization for artisanal operators. And by that, I really mean that what we need to do is create a kind of virtuous circle in which greater formalization for artisanal operators kind of goes hand in hand with securing access to more affordable finance. Okay, obviously we're currently a long way from that, and the final 2 points on this slide sort of point to that. One thing is just to say that the operating environment in DRC in particular is very challenging, and it creates a number of barriers to formalization. It really sort of pushes artisanal operators to remain in the informal or the illicit economy. And one of the key themes that we picked up, one of the reasons for that is that the Congo market is sort of systematically undermined, if you like, by what we call regulatory arbitrage. And what I mean by that is that Congo's neighbors, so particularly Rwanda and Uganda, but also Burundi and Zambia, firms and off-takers based in those markets often are more competitive as buyers because their operating costs in those jurisdictions are just lower than the operating costs and the regulatory compliance costs for their Congolese competitors. So you've got this sort of drain that creates a smuggling incentive cross-border. Okay, let's move to the next slide. Great. So this is quite a short slide, but I think there are two main points here. The first is that at the moment, banks and investors just don't see the ASM sector as an opportunity to make market rate financial returns. So currently, banks are just not lending to this segment of the market. And in fact, one of the bank CEOs that we spoke to in Kinshasa had a good phrase to sort of sum this up, and he said, le jeu n'en veut pas la chandelle. In other words, it's just not worth the effort. The financial risks kind of outweigh the rewards. And I think actually it's worth pausing to sort of paint a quick picture of the Congolese banking sector, because it's really quite different to European or North American kind of financial sector. So there's just a few points here. Number one, it's a very small, illiquid, and quite conservative financial sector. Relatively few banks with relatively small kind of asset base. And from a borrower perspective, even when credit is available, which most of the time it isn't, the interest rates and the fees can be prohibitively high. So to give you some numbers, loans to SMEs in the DRC typically range from 15 to 22%. Much higher than that, and you're sort of into microfinance territory. But the killer, if you like, is not necessarily the rate of interest, but the nature of the loan tenor. So typically that'll be 1 to 3 years, but no grace period is offered. We couldn't find a single bank that would offer a grace period. So what that means is artisanal operators, if they were to borrow, would need to be repaying on the principal sum immediately. And for the most part, they just can't do that. So that's one challenge. I think the second thing to say just about how the banking sector works is it's not really focused on business lending. There isn't that much interest. The main focus is actually on a kind of low risk model where, banks can be quite passive and make quite a profitable spread between, the low interest bearing cash deposits they get and where they can stick that cash into kind of high interest government bonds. And then obviously the other way they make money is on quite high fees for money transfers and currency exchange. Just a third point then on the banking sector in the DRC in particular. The balance sheets of most of these local banks, even the largest ones like Raw Bank, are generally too small to lend at the exporter level. It's quite capital intensive. And so local banks would really need to pool credit to lend effectively at that level of the value chain. And then finally, I think really key point is just that there's a lot of inflexibility when it comes to definitions of loan collateral. This is obviously a big problem for artisanal operators because by definition they're mobile. And by definition, from a bank's perspective, that means there's a non-payment risk, there's a flight risk. So in terms of how kind of bank decisioning works, typically it's predicated on hard, non-movable, non-transferable collateral like land or buildings. And the bank would want to see 150% collateral before they consider a loan. Which, for us, that's really unfortunate because I think in the artisanal mining sector, there's an opportunity for more flexible forms of collateral to be considered by loan officers. And, example would be a formal offtake agreement or kind of real-time cash flow reporting mechanism or maybe kind of most interestingly, independent geological studies. So I think, those are some key things to understand about how the local banking sector works or more precisely kind of doesn't work all that well. And then the second point on this slide, just quickly, is a simple one, which is that different types of lender worry about different types of risk. So what you'll see here is kind of on the left-hand side, we've kind of put, I can see a couple of labels are missing, but don't worry. On the left-hand side, we wanted to put kind of local banks and just point out that they're really cost and profit driven. So, they're looking at can they make a commercial return on their loans. And then all the way on the right-hand side, we wanted to put DFIs, the development finance sector. And really what we found there is there's less of a concern about the exact rate of financial return. There's a willingness to take a risk, but there's a very stringent concern about reputational and integrity risk. So for DFIs, the concern was if we're going to support any program that lends to the ASM sector in the Great Lakes region, can those borrowers meet full IFC performance standards? To which, the immediate answer is no, or at least with great difficulty. Okay, let's jump to the next slide, and I promise to speed up.
You're doing fine, Ash. It's fine. Go ahead.
All right, thanks, Jen. Okay, so I wonder, have we missed a slide, or have I got my order wrong? Maybe we have. Okay. I think Yeah, on this slide, I think it's just a table where we wanted to summarize what the key barriers to financial access for artisanal operators are, and just to get it kind of into a list format. And to make it onto this list, what we wanted to see was different interviewees from different perspectives, borrowers, lenders, participants in the supply chain, telling us the same thing from different angles. So some of the points that came up were, number one, this conservative lending culture. I've just covered that, so I won't say more. Number two, maybe a bit more subtle, this point, is just that there's a total lack of internal capacity within banks in particular to measure risk in relation to the artisanal mining sector. So none of the loan officers really understand this sector, and how to kind of gauge ability to repay, for example. The third point, really important one actually, is that the transaction due diligence processes within banks, both local banks and global banks, tended to be very binary, which led to what we call kind of default disengagement. So as soon as any type of risk was identified, that was it, automatic kind of discontinuation and disqualification of the loan application process. Not dissimilar to what we saw with refiners who were looking at new suppliers that were sort of non-industrial, non-formal. Okay, and then just moving down, lack of formalized, organized and legal upstream structures. So that's a very sort of general point, but I think just want to kind of underscore and sort of underline just how informal artisanal cooperatives or artisanal operators can be. When a bank is considering offering a loan, access to credit, they want to see a company structure, they want to see organized kind of management information systems, a record of accounts and so on, and that just isn't there. So there's a lot of investment readiness work that would need to be done, I think, for artisanal operators to borrow as they stand. Next point, Hélène has covered, which is just that there is this widely held negative perception within the financial community that ASM means high risk and it means not commercially viable, which for us is unfair, and I think there's what I would call a perception gap here. The artisanal mining sector in the Great Lakes region is a major driver of kind of economic development, job creation, and so on. And I just don't think that's recognized within the formal financial sector. So there's a kind of outreach and education requirement there. Okay, next slide. Thanks, Jen. Briefly to comment on the existing upstream due diligence programs. I think I'm not going to kind of go into detail here, but just one broad point from our perspective, which is thinking about access to finance. It's just to say that I think the primary focus of existing due diligence programs is kind of access to markets. It's focusing on tracing and validating the supply chain, but there isn't necessarily a concerted focus on kind of opening up opportunities to access finance for all upstream actors. Obviously, it's almost a statement of the obvious, but I think it feeds into some of the recommendations that we're going to make later on. Next point, actually, we've already covered, so we can skip. And then this final point is, the kind of the lack of compliant upstream actors in the artisanal sort of segment of the market. And this is really about cost. It costs money to participate and comply within a due diligence program and framework, and that's an expense that not everyone can afford where margins are thin, and you're talking about quite small operators. Okay, next slide. Great. So this is the last one I'm going to talk about in any detail, really. So obviously, what we've done in a 20-minute sort of whistle-stop tour is to talk a lot about problems and challenges. And I think on this slide, I want to turn the conversation to what could be done. What are the potential solution kind of areas? And the way we thought about this was, what sort of vehicle or platform could be useful to catalyze lending by formal financial institutions to the artisanal mining sector, or should we say the responsible kind of artisanal minerals trade. And we really came up with 6 different options. Some of them are similar, but we felt they were all mutually exclusive and they were worth commenting on separately. So the first one is, we call it establishing a financing facility within a local bank to provide loans to the artisanal mining sector. And obviously the rationale there is that domestic banks are the main existing providers of working capital in the market in the DRC. And the way this would work, just very briefly to kind of paint a picture, is first of all, you'd identify a private Congolese bank that's reasonably well established, well capitalized, compliant with IFC performance standards, of which there are only 2 or 3. I've mentioned one already. But having sort of identified that local bank that has a footprint, the idea would be to set up a standalone ASM lending unit where you can train loan officers to really get to grips with the artisanal mining sector. And then secondly, bring in a development finance or multilateral institution to provide loan guarantees and lines of credit on a concessional basis. So, that would be risk sharing with the bank, maybe taking up to 80% of the risk in the form of a guarantee on the loan, in order that the bank can lend to higher risk borrowers in the ASM sector and require less in terms of collateral. Then a third sort of component of this model would be to bring in a grant-funded technical assistance facility that would act as a sort of sidecar to this new ASM lending unit, where I guess there would be 2 directions for the support from that TA facility. Number 1 would be to build up capability within the bank, within this lending unit. Number 2 would be actually to work with a kind of pre-screened group of artisanal operators to get them investment ready. So to help them formalize to that minimum threshold they need in order to borrow through this scheme. And the idea is that one could have a demonstration effect. Once you can prove that it's possible to lend to this segment of the market and do so on a commercially sustainable basis, you could gradually remove that development finance kind of grant funded element and start seeing larger kind of flows of credit from the domestic banking sector. The second idea is really just a spin on that first one, which is, you could think about working through industrial mining firms that have a much better track record as borrowers, and then kind of work indirectly with artisanal suppliers through a sort of anchor industrial miner that is working with artisanals on site. Option 3, we've called an inventory financing arrangement between a refiner or a smelter and the most solvent and kind of credible entity in the upstream supply chain, which are the exporters. And I guess this is a model most of you guys will have thought about or kind of worked on before, so I won't speak too much about it, but I do think it's an interesting model because you don't necessarily need to involve the banks if you can work with refineries that are kind of innovative enough to start lending off their own balance sheet, or at least to use their own much stronger kind of credit profile to enable that to happen. Option 4 is really just this idea of having, we've called it a hub and spoke model around a known and responsible exporter. But the idea here is really that you would form an association of responsible kind of artisanal producers under one responsible exporter, and then work really hard to create really affordable and reliable access to finance for that hub export. Option 5, this one I guess is a bit left field, but I do want to talk about it. And the idea here would be to create a standalone asset manager or impact fund to lend specifically to artisanal operators in the 3T and gold sectors in the Great Lakes region. At first glance, it feels like creating a brand new institution to do that makes less sense than working with an existing bank. But actually, my experience, and we've done this work in the agriculture sector in Africa, where informal smallholder farmers are selling into, bigger companies and off-takers. What we found is actually this model can work really well because you have a chance to kind of build from scratch, build a specialist team that understand artisanal mining and that can develop loan products tailored exactly to that market. And I would say there are a couple of interesting examples. One model we're familiar with is XSML Capital, based in the DRC and Uganda. And I think the results from that sort of model are very encouraging. It's a standalone fund that lends to small and medium-sized businesses in the DRC, and it does so profitably. It's working. The money's being repaid. The fund is repaying the LPs and building a good track record. So for me, it is a viable option, even if it's a bit left field. And then the final option we looked at was to create what we called a challenge fund. And this would be a grant facility providing grants or repayable kind of 0% loans to startups or entrepreneurs who have an idea for innovative and scalable solutions for ASM financing in the Great Lakes region. So this is thinking outside of the box. It's a competition where the best ideas get the grant money and to see if they can scale up their proposition. We could be talking about blockchain or kind of mobile financial services enabled kind of solutions, and so on and so forth. I won't sort of dive down that rabbit hole, but I think you get the idea. And a good model for that is the AECF, the Africa Enterprise Challenge Fund, which does something very similar, runs competition windows for grant applicants, but in that case, more in the kind of renewables and agriculture space. Okay, I've talked way too much. I'm going to stop. Jen, back to you and over to questions.
Thank you, Elan and Ashley. That's very helpful. I know that's why people were joining to hear that. So thank you for that concise but good overview.